cut your tax bill by 20%. That's right, 1/5 off the top of your taxes can be cut. If you're a YouTuber or if you're self-employed, you can possibly cut your tax bill by opening what's called a SEP IRA, which stands for Simplified Employee Pension Individual Retirement Account. It's one of the most powerful retirement accounts and saving tools out there if you're self-employed. Now you can also open if you're a small business owner, but for this video, we'll delve into the self-employed sole proprietor aspect of it. Bear in mind, the number and percentages would differ depending on your business structure. For example, if you're an S Corp or a W-2 employee, it could be up to 25% versus the 20% for sole proprietors. Though you would want to discuss this with your own tax advisor, since each person's personal situation could be different. Like if you have another business you're running that has retirement benefits, that could alter what you can or can't do. But the way to think about the SEP IRA is basically a traditional IRA on steroids. And here's a breakdown on why you might want to open one. I'm going to describe a scenario for being a small YouTuber where you don't have any employees, because that's where you're going to have the greatest advantage with the SEP. I think one of the biggest features is the massive contribution limits. When you think about, say, someone that's over 50 on a traditional IRA, their max contribution in 2026 is $8,600. For the SEP IRA, it's possible you could max out at $72,000, so nearly ninefold greater. So if, say, you recently started your YouTube channel and you're running it as a sole proprietor, you can contribute up to 20% of your net adjusted earnings, again, up to that $72,000. For example, let's say your earnings after expenses on YouTube was $100,000. You can basically take 20% off the top of that. So basically you'd only have to pay taxes on the $80,000. Now bear in mind the FICA, you would still have to pay FICA. So you would, though, avoid paying federal and state taxes on this. If let's say you contributed the full 20%, the $20,000. So, for example, in that scenario, just on the federal, not counting state, it's going to be dependent on what state you live in on how much you would save. But just on the federal, you could possibly save $4,400, because if you look at, say, a tax bracket for a single person, that level would be at that amount would be put you in the 22% bracket. So that's quite a bit of that could certainly help you. Basically it's an immediate tax deduction for your business. 100%. That $20,000 you put in, 100% tax deductible for your business. And it directly lowers your adjusted gross income for the year, which can significantly drop, like I said, your federal and state income tax bill. And what's nice again is that the money grows tax deferred until you withdraw in retirement. Now again, this is pre-tax funds, but let's say when you need it for retirement, when you're 75, your income levels most likely will be lower, and you'll probably be in a lower bracket. Or in the case of, let's say, my mother, in some instances, she doesn't ever owe any taxes because with the standard deduction and so forth. Now, bear in mind, with the Secure Act 2, they did recently make changes in the law allowing for what's called a Roth SEP IRA. Now, a lot of major firms have not implemented this yet. My understanding is might not happen till next year in 2027. But you can certainly check with some of the the major firms like Fidelity, Schwab, or Vanguard to see what their timeline is on that. Now that could certainly be a game changer because you could certainly be able to contribute quite a large amount to the Roth. Of course, that would be after tax funds though. So we'll have to see and look into that, and I may do a follow-up video once that becomes prevalent. I think what people really like about the SEP IRA is it's the flexibility. Unlike, say, if you had a 401k where you should always fund it, the SEP IRA, let's say you hit a dry spell, being a YouTuber, that obviously can happen very easily year to year, right? 1 year you're kicking butt and making 200,000, and next year you might only make 50,000. So there's no commitment. So you can say, that year you didn't make much, you can say, I'm not going to do anything this year. I need the funds. So there's no IRS would not penalize you for not funding it in any particular year. What's also nice is you also have until your business's tax filing deadline, and including extensions to fund the account for the previous tax year. So let's say, for example, for 2026, you might not know your exact earnings from there, and you might not know till January, February, March, and it allows you basically to say how much you want to deduct, and you have until April 15th. And of course, if you have that business tax filing extension, all the way up to October 15th to fund it. So it's a great feature. I think what I like best about it, though, is that it's incredibly simple to set up. A lot of firms, you just need 2 pieces of paperwork: the application and what's called the adoption agreement. Very easy to fill out, and you can possibly, if you wanted to, especially if you're a sole proprietor, and that's the scenario I'm going with here. Now versus, let's say, tax filing wise, it's quite simple versus, let's say, if you did a solo 401k, once the balance hits $250,000, you have to file what's called a tax form 5500 each year going forward. And hopefully IRS moves that limit up for those people. But so that's to me, it's the advantages are great. Huge advantages, and massive contribution up to 72,000. And basically easy to set up, great flexibility. Let me know if you have any questions. Throw them down in the comments. But otherwise, have a great day.